Good afternoon, everybody. This is Jeff Scott, and it is actually not yet afternoon. It's 11:24 on Sunday, the 22nd. First of all, happy and safe Thanksgiving season to all, and this is my weekend review. I've entitled it Climbing a Wall of Worry, and since it's before noon on Sunday, there's no NFL games to report yet, nor are there futures. Disclaimer, as always, this is for educational purposes only. I'm a doctor, not a broker. I am independent. No one pays me to say anything, and I pay for the tools I use. Trading involves risks, and you alone are solely responsible for those decisions that you make. I'm really a product of two worlds. I learned by learning CanSlim as taught by O'Neill, improved upon and made electronic by HGSI, led by Woodward and Brown, and then really modernized with Morales and Catcher with pocket pivots, Bible gap ups. My buddy and co-teacher at a number of live events is George Lee, and my long-term teacher and shorter-term friend, as I moved to Florida and popped in his office and we've become friends ever since, is John Person, who's just a great trader, teacher, has developed indicators that haven't changed in 20 years. I've been using them for a long time. These broadcasts really started as a support system for HGSI, and so I've resisted using other tactics. I've had a lot of requests to really just show you how I actually look at the market, so I've been including John's stuff more and more because I use them, especially as I take that buy list and leadership list that I might get out of HGSI and move it towards a actual trade. I have a lot of programs, but what I really rely upon are TradeStation, Thinkorswim, my real-time trading platforms, and Genesis, which I do believe is one of the best real-time charting platforms, but is expensive, requires separate data source, so I don't spend much time in it on these calls. I use HGSI for my analysis, both pre- and post-market, EdgeRater, and then I like seasonality, and we'll look at some seasonal plays today as well. I always like to look at this picture of what the market looked like at the end of the day Friday. It's the major sector ETFs and a few others, and you can see where the strength was. You can see that banks were weak from a supersize, but some of the regionals had some green. Insurers were green. Utilities were green. Now, if you think about interest rates, if they're going up, that should be good for the banks, bad for utilities. It should be bad for REITs, and you could see that my REITs were all green, and several of them showed up. So I see a little bit of some confusion there, and perhaps it's the Goldilocks syndrome, and maybe we're getting the rates just right. We'll see. Other things to note, healthcare had some strength. Biotech was mixed. Airlines were strong. Home builders were strong, again arguing that rates are not going to rise quickly. I like to look at my major markets. This is a view I do in Thinkorswim. E-minis, NQs, YMs, TFs, the VIX, and the dollar. So I look at this, and we'll look at it again in other pictures, but the point here is we have broken out, not quite to new highs, but approaching new highs on the E's, the N's, and the Y's. We're not there yet on the TFs, the Russell futures, but everybody's broken above their 17 and their 50-day moving average, including the Russell, and hopefully these will now become support and not resistance. The VIX is languishing here, not quite as low as it's gone, and the dollar is sort of going sideways. This is the genesis of the same thing, the E's, the N's, the TFs, NYSE, and the YMs. I have a 60-minute, a daily, and a weekly. And the point I wanted to make is, except for a little bit of a sell-off at the end of the day, and I mean little bit of a sell-off, a few S&P points, the markets ended the week strong, and all my indexes are on weekly and daily buys, and still some weekly sells on the TFs and the NYSE, but the S&P, the NASDAQ 100, and the YMs are on weekly buys rather. So that is consistent with strength in some of the big stocks. Rates didn't do a whole lot on the week. They were up 0.14, at least on the 10-year treasuries yield. And I think that's kind of why you saw some strength in stocks that like falling rates and like rising rates. Interestingly, regional banks were all over my top charts of the weekend, yet the big money center banks were not seen. The advanced decline line can actually be plotted like a stock, whether it's weekly candles or daily line chart. And I think the point of this chart was we're sort of done falling, trying to work our way higher, and we probably have some resistance here to get through on the 50 weekly. We're at the 17 daily right now and heading up towards that 200. But if anything, the AD lines have come off their bottom. And market participation, whether you're looking at stocks above the 200, which broke through this trend line and now bounced nicely above it, but still have a ways to go. And the same thing on stocks above the 40. We've come down from our recovery, but heading back up. Canaries in the coal mine. Kramer likes to talk about FANG. And these are lists that Ian, the real Kramer, I'm just kidding about the real Kramer. He's smart. I think Ian's much smarter than Kramer and more honest. Although I guess the Kramer of 2015 is the honest lookout for the little guy. Just go back and look at some old YouTubes. Enough editorial there. I like him. I love his books. I like listening to him. I just think that he was a manipulator in the past. But that's personal opinion and really nothing else. And like I said, he does come off now that he cares about the little guy. If you look at the canaries, these are a list. Although Priceline is really underperforming right now, the canaries are nearly breaking out to an all-time high. That's got to be good for the market. Market thoughts, we've been climbing the wall of worry, the Paris attacks, worldwide weakness, rising rates probably in the U.S. I did think we'd see a sell-off at the beginning of the week. It sort of occurred in the pre-markets, but then recovered and led to a week-long rally. Fed speak still talks about tightening, but they keep trying to play down the speed of tightening. And what's working? Finance, as we talk about regional banks, insurers, and REITs. Defense, with the saber rattling in the Mideast and in Europe. Tobacco, a nice defensive stock. Airlines, certainly taking advantage of low-cost fuel. Selected technology, and my big boys, the canaries. Longer term, go take a look at 2011. We're still meeting that theme. Is a correction over? Probably. Are we still in a topping period? Probably. I'm looking for next year to be tough. This was not an easy year for most. And next year, in the 7th year of an 8-year presidential cycle, the 3rd year of a 4-year presidential cycle are usually great years. And, we're more likely to see a larger pullback in the final year. Slowing worldwide economy versus full employment in the U.S. The Fed's on the hot seat. I think they want to raise, and will be interesting to see what happens. And when I say the delay in rate increase hurts stocks, I think it hurts bank stocks. But the interesting thing is it's getting harder to predict the response of the market to good and bad news. I think we need to raise rates. Risk management is prudent. And we've already gone through the month now of October and early November where major bottoms occur. And now I'm looking to see if we'll go back to old highs. Things like the Hindenburg become more relevant as we start that move back towards old highs. Remember, patterns are cyclical. It certainly feels like we've entered stage 2 and stocks are going up. But, I've said this before, and all it's been is sort of a trading range sitting here at the top. Regardless, I feel more bullish this week. But we've had one good week, one bad week, one good week, one bad week for some time. And last week was a very good week. Your market approach must change with the cycle, so I've started becoming more aggressive, taking bigger position, buying stocks, buying calls. Still not selling a lot of puts yet, although I often sell put spreads against my positions that I'm taking to generate money to pay for the calls. Covered calls, it's kind of like doing a vertical call spread as well. I am taking some premium because I do think that we're still in a risky period of time, although certainly more bullish than I've been. Know your news and your earnings dates. So as I look at this, obviously we have a holiday this week, so there's nothing on Thursday and Friday, which means we're going to get the continuing claims for November 14th will come out on November 25th. The last employment numbers were strong. Housing numbers, GDP, which was second estimate, new home sales and some gas inventories round out the news. Earnings slow down on this holiday week, but we got some big ones coming up. We've got on GameStop on Monday before the open. We got Palo Alto Networks. On Tuesday, we got Burlington stores. We know that the off-price stores have done okay. Take a look at Ross, for example. Burlington, I think, is in that category. It'll be interesting to see what it does. DSW, another big stock, or a discount retailer stock at least. On Wednesday, nothing to really that big about. An interesting Thursday. Hard to believe Fuel Sys is going to come out right before Turkey Day. Maybe they're planning on laying a turkey. So, as always, that was my intro. Now I'm going to take a look at the market, do my top-down analysis, some bottoms-up work, have a chart of the week to go over this week, which we'll do in a few minutes. But we'll finish with that to keep you guys engaged. So very quickly, let's go through my Excel spreadsheets first. I always like to look at last week. So this report here takes all the stocks that I had in my list on Saturday morning. So these would be lists that I download during the week and on the weekend, lists that I create, and I look to see how they did over the next 5 days. Now, some like my current holdings, I'm not saying I kept everything here, but this would have been happen if I didn't do anything. I said this was a good week. I wasn't kidding. Over 80% of the stocks that I owned at the end of last week were up on the week for a 4.64% return. My buy watch was up 4.87. Typically, my holdings look more like my buy watch at the end of the week on a bullish week as I took several of the trades. My filtered buys, where I try and take that 18 stocks down to just a handful, they were up similarly at 3.85%. 4 out of 5 went up. Growth was in vogue. You can see the S&P was up 3.2. What a great week. The GIF All-Stars about the same. Market Smith 250, the IBD 50 a little bit better, and the HGS 100 2.17%, but still 76% of the stocks were up. Very few groups were to the downside. Interestingly, high beta stocks were kind of neutral on the week. So, strong market. I mentioned Hindi, something to be concerned about again, and what I'm going to look for is when I get 4 yeses. Now, I need to have both new highs and new lows above 2%. I got them. I need to have a McClellan less than 0. I don't have. The spider, which is my moving average, has to be rising, and the new highs and new lows have to be both above 2.2%. We made every criteria except for the McClellan being less than 0. So that's interesting because the prior week it was. So what does the Hindi signify? The Hindi signifies a high-risk market. It signifies that we're at higher risk of a rolling over. When I see multiple Hindis at the same time, I get nervous about tops. And, you know, if you look back over the last 50 or 60 years, no major market fall has occurred without a series of Hindis preceding it. Yet 1 out of 4 Hindis is meaningful. The others are just small corrections. So we haven't seen a Hindi back since July. We had a couple of Hindis during the year, but not really a series. We don't have one here. Being close is not like hand grenades where it matters. I'm just going to keep an eye on it. Buckets, looking to see how many stocks are above the midline of their Bollinger Bands in the S&P 1500 at 58%. That is bullish, but that is not overdone. If you look at the distribution of stocks, it looks kind of like a bell-shaped curve for college, and again, or any school rather, not showing any evidence that we're overdone to the bought side. The markets had been in a buy signal. This here is the Woody indicator, and they went yellow. A little bit of danger signals coming in here, And then you could see what happened on Wednesday. We got a series of kahunas to the upside, and that flipped us back to yellow. And we'll see if we can't move into the buy signal on the Woody indicator this week. From a seasonality perspective, I hope to have time to come back to it later, but I just wanted to point out that I could take EdgeRater and run all the stocks in my universe to kind of look at which stocks have a lot of positive years going forward over the next 4 weeks. And if I look at over the next month, you could see there are some stocks that look kind of interesting. FAF, don't know what it is. I think it's sort of I don't know if it's a pawn shop or some type of specialty finance, up 17 out of 20 years, average of 11%. Brinks up 18 out of 19 years, average of 7%. Weyerhaeuser, I think, which used to be in the paper and trees, is now as a REIT, up 18 out of 25%. And notice there are some other REITs in here, which I think goes with seasonality as well. And I said the REITs were strong. Now, I might want to tighten this list down and eliminate anything that had more than 3 negative years. And this is what I came up with. If I want to look at those stocks that have more than 8 up years, less than 3 down years, and I want to just look and see if any of them had some good performance. So here's First American again, 17 out of 20, 14 out of 16 for Cemex, 12 out of 13 for Align Technology, 12% return. mTOR, 13 out of 15, 10% return. WePro, 12 out of 15, 10% return. Gray Television, 12 out of 13, 21% return. So there's a lot of interesting plays here. Pilgrim's Pride, 11 out of 12 years positive, average return 18%. Genworth Financial, not a great performer, but 24% average over the last 11 years, up 10 out of 11 times. So there are some big, big movers. Cheer Channel Outdoors, I think they do a lot of the, it's a REIT of the signs on the highways, up 10 out of 10 years, average 10%. So there's quite a few here you might want to go look at. Commvault Systems, up 9 out of 9 years, average 12%. So I just put this here to give you some ideas of things you might want to look at. I generate this with EdgeRater for those that are interested in seasonality but don't want to spend the thousands of dollars that a seasonality program requires. EdgeRater often has deals at the large meetings, but it's $2,000 or less. It can interact with HGSI data, but can also do Yahoo data. And I could sort of do this simple scan with fixed time periods. So market should be in a fuego mood. Let's look quickly at my TradeStation market analysis. So what I'm looking here, I'm going to look for 3 or 4 things. I'm going to look at the arrows. These are John Person buy and sell signals. Obviously green is a buy, sell is red. I've got daily, weekly, and monthly. The second thing I'm looking for is the color of the bar. Elder has a thing called the impulse indicator. When it's green, he says the buying window is open. It's okay to buy or hold. When it's red, the selling window is open. It's okay to sell or hold, but not to buy. You shouldn't be selling when it's green. And when it's blue, you can make your own call. Third thing we're going to look for are little dots that might be attached to the price bars, and those would be a screener telling me that we might be having some MACD divergence. The fourth thing I'm going to look at is the high jump and make sure that nothing's coming up above 85 or 90. And this is showing extension from the 1750 and 200-day moving averages, and it's comparing back to 200 bars and looking for things that might be extended. NASDAQ, green, green, green. All buy signals are in play. NASDAQ is really being led by things such as Google, Facebook, Netflix, Apple. Dow, green, green, and green in buy signals throughout. 87%, that tells me we're starting to get extended. But as I look here, we still have a ways to go to the envelope and to take out prior highs, and the prior highs have to be my target. S&P 500, not quite as clean. Green and green does have a sell signal on the weekly still on John's stuff, but other than that, everything's green and looks okay. And then the small stocks should be the weakest. Let's take a look at the IWM. And we are at a short-term buy. We're in a weekly buy. We're still in a monthly sell. And I think we pointed out earlier that these are the ones that are struggling. I looked at the sectors very quickly. Materials looks great. Buys throughout. Blue here on the monthly, but green buy signal as well. Energy gave back some last week. You could see here, and it's in a weekly and a monthly sell, so probably the weakest. Financials in a buy mode across. Industrials in a buy mode. Technology in a buy mode. Staples. Notice the little red dots here show that staples were having a little bit of a divergence here on the weekly, and they had it back here, and you notice divergence can go for multiple weeks, but did lead to a pullback, so we're going to have to watch that. It did go green on the weekly, but it's a weekly sell on staples, so staples look weaker than some of the others. Utilities look okay, although it's still in a sell signal on the weekly and monthly according to John. It's indicators, but green has popped up. Healthcare had a nice week. Daily and weekly look good on a sell signal on monthly, and discretionary on a daily buy and a weekly sell. And you notice on the discretionary, you got some of that MACD divergence concerns. So that just gives me a sense of what's working in the market. One of the things that I like to do very quickly, again, just to test that, is I go to my scanner, and let's just look at all the stocks in the market for an example. A buy signal 1 tells me that, so we go to buy signal 4. Buy signal 4 says John's giving it a buy signal. It's not a filtered buy signal. A buy 1 tells me it's a buy when it's in a weekly buy mode. So that means it's been in a long-term uptrend, it's pulled back, and now it's triggering a buy signal. So that, to me, is a pullback in an uptrend. I like buy 1s. A buy 2 is a daily buy near some support when the weekly's in a buy mode. So I've been in a weekly buy mode, I pulled back to support, and I had a daily sell signal. One of my favorite places to look for. Buy signal 3 tells me I've pulled back to support, but I'm not necessarily in a weekly buy. And buy signal 4 means I've got a daily buy, but nothing, it doesn't matter anything else. So on my daily buys on Friday across the entire market over $2 and 150,000, I've got 202 daily buys. If I look at a sell 4, I have, I think I said 112 or so. I got 112 sells. So that tells me I've got 2-to-1 buys favoring the sells. So across the broader market, that makes me feel pretty good. If I come down here to, let's see if this is run yet. All right, if I look at just the S&P 500, I have 29 buys in the S&P 500 versus 15 sells. So I have bullish, I don't want to call it momentum, but I have more bullish stocks than I have bearish stocks as I look forward to this coming week. Now, I'll just finish up my work over here. Hold on one second. All right. So now let's go into HGSI. Not what I wanted to hit. Let's look at the warehouse view. And let's go into user group 1122. Actually, I don't want that one yet. Let's go down to Woodward & Brown user group, Major Markets Plus, and let's go to the T view. The T view is all price and volume, heavily weights recent. Does look back 13 days for a little bit. If I look at what's been leading, the small and mid caps, the NASDAQs led the market this week. What does that tell me? Remember, this is short-term story, mostly yesterday's work or Friday. Since I'm a growth investor, that's kind of where I live. It means I had a great week, which I did. Gold, silver, oil, volatility, bonds, commodities at the bottom. That is great too if you're a long-term trader, unless you're a gold bug. Let's take a look at, in the middling here, the S&P 500. And we know that on Wednesday we had kahunas in all the major indexes, so I don't really need to look at a very busy, but I do want to show you something. And actually, I think it's going to be on this chart too. Okay. So I've had some, in my mind, confusion about the Hindenburg omen because there has been a change of how we measure it. So here we are in October 2006. All right. And you want to see a nice market move. Just see how nice this market move was. From this doji, which pulled back towards the 17 weekly, until we got to the highs up here, we had seen a 17% move in 195 days. What I want you to start looking at are these two top rows. The two top rows uses two different calculations for the Hindenburg. And you'll notice that as we started getting extended, we started seeing these Hindenburgs. That should have been the signal to be concerned. So as we got these signals, and as soon as we took out the 50 here, the market rolled over and had a pretty big fall. So the Hindenburgs occurred, you took a series of them, a number of small moves, and then the market collapsed. Now, had you gotten out at that first Hindenburg, you would have been pretty happy, but you still would have missed some of the move. Think of the Hindenburg as when the professionals realize the market's topping and the amateurs like us are starting to jump into the market and we want to buy. So we're buying what the professionals want to sell. They're distributing without the stock falling as they're unloading their shares to us. So the Hindenburg called the top. Market fell, and then as markets do, market started to recover, and it started to set a new high, and we hit another Hindenburg and another Hindenburg. So that would have been enough to shake me out, and it did. And look what happened. Another series of Hindenburgs, and this was the big market drop of 08. Now, had you played the game of taking the weekly bongo when it went red after the Hindenburg, it would have kept you out of the market for a lot of pain. You can see a series of Hindenburgs, and when did that bongo go positive? It went positive in April of 2008. And what did we see there? We saw a little bit of a rally. And could this be a more classic pattern failing at the 500, followed by the weekly bongo turning red again, and you're still out of this market, still out of this market. Had a small rally here. Didn't really hurt you if you took it. Pretty classic failure here, the 50. And now we're getting interesting. We're starting to see some bottoming tails. Kind of base forming. I'm out of the market. You're probably out of the market. Still the weekly bond goes red. Failed at the 50. Notice the weekly bongo went green at the end of December. not much happened. It's back red. Market's dropping. And there you have where the market reversed. Now, the problem with the bongo is it would not have gotten you out until the end of March of 2009, and the time to get in was earlier. That said, it kept you out and kept you in the market. Look at that weekly bongo, still green. In the market, all the way until January of 2010. So, had you bought when this bongo went green, so it would have been here at the end of the day there, we'll get the worst possible one you can get. And held it until the bongo went red and sold it at the end of the bar, you would have had a 33.5% move over 207 days. Notice no Hindenburgs. Market pulled back, bongo's green again. Nice little run up. Stay out of the market, the bongo weekly's red. Little head fake. Again, it's the bongo weekly is slow, but it should get you in the majority of the move and prevent you from getting major pain. So this got you back into the market September 2010. So now you had another run. From the high of that bar to the low here. 15%. Notice no Hindenburgs. In 11, the weekly bongo got you out at the 200. You avoided some damage, got you back in down here. That's not the point here. The point is to look at the lack of Hindenburgs. No Hindenburgs, no major corrections. And that gets us to where we are now. We're getting closer. That's 13. We had a couple of Hindenburgs come in 14 in December. Small market pullback. And then we've had spurious ones this year, but nothing like we saw in the past. Now, had you taken these two Hindenburgs, all right, and said, I'm going to take this weekly bongo as a sell, and I got out here, and I would have gotten back in down here, I would have avoided a small pullback, and I'd be back in the market and capturing where we are right now. I just, not telling you that you have to use the weekly bongo, but I couldn't resist because the weekly bongo does what it's designed to be. Keep you out of major downturns, get you in, capture the majority of a move, and prevent you from getting major pain. More importantly, I'm looking for kahunas, and I am definitely on kahuna watch, not kahuna, Hindenburg watch right now. So let's take a look at where we are. We came back, almost tested the 50, took out all the moving averages. There's no averages above me right now. This is a very bullish looking market. My Hindenburgs, my bongos are green, no Hindi. We're above, I think we go higher on the S&P. Take a look at the Dow. Similar story, green on both the daily and the weekly bongos. Broke above all its moving averages, sort of even a high closed doji here on the Dow, but it's moving up. I can't call it that. Dow looks strong, looks to take out. And I'm looking for a test of the old highs as we run into the year end. Now the Dow has two components. Utilities have been weak. But if I look at the transports got to get above the 200, but perhaps led by airplanes and maybe some of the freight carriers. Maybe we see the Dow Jones Transports break out. A break above that 200 will be nice confirmation that for the market as a whole. But bottom line is, you've had an 11% move off the bottom, and both bongos are green. So cautiously optimistic there. Take a look at the NASDAQ. NASDAQ also, I think, getting ready to run towards highs. I thought this was a very bullish retest here, and because it got a little bit below the 200, but it really came back and tested the gap, held it where the gap started, and bounced back up. I think that's a very positive sign. Bongos are green, and then the Russell 2000, the one that has more work to do, has to get probably is going to have some trouble getting up above the 200. We'll see. Its bongos are green. Hard not to be bullish looking at this, at least short term. The dollar, in reality, it's a trading range here, really not doing much. Put on a weekly, and you could see that it really didn't have a big move on the weekly. But you go from the bottom to where you are now, you've had a nice move off of the bottom. So dollar's holding its own. If we raise rates while the rest of the world is lowering it, I expect the dollar to go higher. Volatility, not as low as it's been, but volatility failed again at the moving averages. Dollar strong, then you'd expect gold and silver to be weak. Here's the spider gold, and here's silver. Someday in the future, these guys will be interesting. They just aren't now. All right. Next thing I want to do is take a look at the industry groups. And let's look at what's really moving now. 2-day force, I got 75 groups to the upside. Probably don't have a lot to the downside. I've got 8. So let's see what we got to the downside. Precious metal, silver and gold. Now it's interesting because you got diversified banks. So I mentioned that the big banks, the money center banks, Bank of America, Citigroup, so on and so forth, did not make the positive list. Steel, energy, private equity got hammered because of Valiant. Home improvement, that's interesting with what Lowe's and Home Depot did. Kind of surprised to see that. And I guess it's other things, American Woodmark, Masonite, etc. If I look at the 2-day force up, that's where all the fun is. You could see that the banks, which are the regionals, actually are here. So industries doesn't count. So let me kill the industry one. Industry is just an index of the index. Hit delete. I'll come back here. E-commerce, specialty apparel, semis, REITs. Got a couple of apparels. Maybe time of year is good for apparel stores. We've got airlines and biotech making the list. E-commerce, discretionary. Let's take a look at what got to our list. Right-click, change index group. No shocker here. Some of the best things in the market have been from this group. August 24th was a great day to get into Netflix. Netflix has had a major run. Let's go into the dirty charts. So in the dirty charts, Hindenburg is covered up. Pocket pivots and kahunas. OBV with its moving average. The same 8-day, 1750 and 200 moving averages. The 8 days exponential, the others are simple. This gray line is group strength. Here's my bongos. The daily is on top, the weekly on the bottom. Backwards. The weekly is on top, the daily's on the bottom. Here's my force, the 13 days on top, the 2. This is my high jump, red candle highs and green candle lows. And then the next one's Bible gap up, squeeze, MOBOs. This is PSAR dots. So I look at Netflix. Netflix is about to challenge its all-time highs. It's pre-split highs, doesn't have much of earnings per share growth. They seem to be valued on signups. The fail-safe trade of every year in seasonality is on Netflix is typically the January quarter. And you can see in the January quarter, see the January earnings are the 18th. And if I go into the data one, you could see that starting on January 19th to February 29th, so after earnings, up 10 out of 10 years with an average return of 30%. Doesn't seem to do much from seasonality between now and then. So coming up near highs, pocket pivots and kahunas, everything is green. Would I be buying Netflix here? I have a substantial option position. What I'm probably going to do is sell premium that expires before earnings come out. VIPs, bingo here. This is sort of the baby's out with the bathwater. Some volume came in at the end of last week. OBVs coming off the bottom, still below the moving average. Doesn't look great, but it looks to me like it's trying to reverse. Alibaba, reversing off the 200. Here's a stock that's interesting. It actually had good earnings. You could be looking to go long Alibaba if it takes out its PSAR dot and the market is strong. I do not have a position there. Next one is Amazon. I have a big position in Amazon, and I've talked about it before. I bought in sometime around 450. So if I remember correctly, what I did here is I did a somewhere in this area, I bought a synthetic long, which meant I bought Amazon 450 calls and sold puts at the same time. And Amazon had a massive move up. The puts expired worthless. And now I've got a fair amount of Amazon calls that are deep in the money that I just keep rolling and selling premium against. The bad news about rolling them is they stay short-term gains. But the reality is, how many shares can you buy at $675 a share? I can buy a lot more calls. I roll the number up over time, so I keep putting money in the bank and giving me a paycheck. And I am very bullish on Amazon until it says I shouldn't be. Now, on Monday, I got a little nervous as Amazon on Monday had a pretty deep pullback. Pulled down to 622. It closed at 649, or the high was 649. So it had a 27-point swing, and in a big position, that was a lot of dollars. But as I said early in the day, I took off my stops before the market opened, and I didn't get stopped out. I see earnings per share coming in. I like Amazon. It's expensive. JD.com, sort of a Chinese eBay type stock, eBay/Amazon. Turning green here, mobile breakout out of squeeze. A break above the 200 could be interesting. So this has really been a group to have been in. Specialty apparels. Now, I almost picked this as my stock of the week. On one hand, it's gapped up and had a 25% move on Friday. Bible gap up, mobile breakout, kahunas, a PSAR reversal. Now, reality is when I look at it on the weekly, it's not extended at all. In fact, it looks like it came out of a weekly squeeze, and it could run all the way up to 35. I think that ANF is a risky buy because of the big gap, but you set your stop at the bottom of the Bible gap up day, and you let her rip. And I'm going to take a position on Monday in ANF if it takes out the close, and set my stop at the bottom of the gap day. Raw Stores, you could make the same argument. Also, Bible Gap has good earnings coming into the stock. Foot Locker, they all look the same, don't they? In downtrends with a gap up. Gap on bad numbers actually gapped up. I prefer the others. And TJX also gapped up. So I like the first couple here. And I don't have a position. I do have a long-standing position in Burlington. I decided to hold on to it, and I'll have to make a decision during the day on Monday whether I keep it into earnings or not. Earnings are on Tuesday. Semiconductor devices. Intel's breaking out to new highs or recent highs. Back in January, it was higher. Everything is green. Kahuna's OBV crossed above its moving averages, pocket pivots. Hard for me to get excited by Intel. Pays a 2.8% dividend. Let's look at it on a weekly, because on a daily it doesn't look bad. On a weekly, Not nearly as nice looking, but moving off the 50 weekly moving average should, I think, come up here and test these highs at about 38, which is about a 10% move here. For those that like to chase things off the bottom, Ambarella looks interesting. It had a mobile breakout from a squeeze, a kahuna, and a pocket pivot on Friday, including and a PSAR reversal. Group is certainly showing strength. A move up to the 200-day moving average from here would not be unusual. That's about a 20-point move, probably 35% overall move. Just be careful. Make sure you keep your stops somewhere below the low of this move, which will be down here. So you're going to take about a 10%, 12% risk. I think it's not a bad play, but I would also comment I felt the same thing back here, and it failed. Fairchild Semiconductor, I think I saw that they got bought last week. You know, I look at AVGO. Is this a long or a short? Let's look at the weekly. As I said, is it a long or a short? You know, weekly looks like it got above the 50 weekly. It's in a squeeze here. Weekly looks like it might go longer. Notice the bongos are red. Let's look at the daily. The daily bongo went green. The weekly bongo still red. I think that if this market breaks down, I want to be short AVGO. But it wouldn't surprise me to see it pop. Since I'm neutral on it, I'm not going to take the trade. It's been struggling here at this 200. REITs. Let's take a look at Weyerhaeuser because that was one of those that had some really good seasonality. Weyerhaeuser has been in a downtrend, did break above the 200. It pays a 3.9% dividend. And let's look at it on my seasonality trader, WY. So here's how I handle this. See a stock that's in a nice uptrend. Now the bad news is it's already broken above its trend line, or not trend line, but it's, yeah, I mean, it's been its channel. I look here and it tells me it's up 9 out of 10 years, average up 7.4%. I'd rather buy it further down. I'm going to pass because it's at the top of its line. And look for something that is not in the channel where it's likely to come back. Now, if it came back down here quickly, I'd reevaluate. Doesn't mean it's not going higher, it just seems it's a little higher risk. As I looked at a lot of these, this pattern is very similar. These been in a downtrend, concern about rising rates, which is typically not great for the REITs. But Prologis pays a 3.7. There were a couple I picked on my list, so we'll look at them in a little bit. Just need to do a quick check of my fantasy football, make sure I deactivated Alshon Jeffrey because he's injured. Let's see. Yep, we're good. All right. Sorry about that. Back. Electrical power equipment. Can you imagine? We've now looked at Intel. Now we're looking at GE. Isn't that a pretty chart? Mobile breakout from a squeeze, coming off a high base type formation. OBB looks good. Volume coming into the chart. Don't like its earnings per share growth. Do like a 3% dividend yield. On a weekly chart, breaking out of a trading range here. I think GE looks interesting. Not my kind of stock, but I can't argue with the picture. It's not just like Intel. It is leading the market right now. What a surprise on that one. Eaton Corporation, not so much. Banks, I mentioned regionals. You know, when a lot of these are foreign stocks. That's kind of interesting. I think the top 3 are foreign stocks. So this is a, before I guess, Well, maybe it's not a foreign stock. This is BBD, small dividend. Been in a downtrend. Look at the group strength is strong. GGAL, nice uptrend here. Don't like its earnings per share growth. Hold on a second. Sorry about that. GGAL, another, looks like a foreign bank by name. Don't really know it. Do your research, but what a beautiful looking chart. Sort of a long cup, handle, breakout with pocket pivots and kahunas. That's a beautiful looking chart. I just throw that in my buy watch list so I keep watching that one. And then another foreign bank, similar pattern, great earnings per share growth. I have to admit that I don't know how to pick these, so I've been doing a lot of this KRE, which is a regional bank ETF and one that's been doing well for me. You could see that on the KRE, it's pulled back, setting up in a flag, looking, I think, to break out to go higher. But I have to tell you that these foreign-looking banks at the top look interesting. Apparel footwear, well, these are stocks that have gotten hit up, but finish line looks good. Then you got to know that these are starting to move. Here's Nike breaking out after pullback to the 50. I believe on earnings, share repurchase, and a split. Under Armour, this was a great buying opportunity. You know what? I should have picked this as my stock of the week. This is when you could put a buy stop above that PSAR dot, put your sell stop kind of where the 200-day moving average is. The reason why I didn't pick it is the volume was weak. The Bongo Weekly is red. The long-term force is red. So right now it's still a retracement and a downtrend, but perhaps a break above the 50 is going to make me reconsider. Similarly, Skeechers got hammered on bad earnings. Now, look at the multiple. Look at the earnings per share growth. It used to be a lot more expensive because there was a split. It's from 54 down to 30. It's about almost a 50% haircut. Again, I'm still a little nervous by it, but I nibbled off the bottom with some calls. We'll see. Airlines, lots to like here. Now, I really thought I was going to pick Alaska Air or JetBlue as my chart of the week. Gotta love the chart. Pocket pivots, kahunas, OBV heading up, has been basing essentially since August. Oil's going down, airlines are going up, coming out of a squeeze. The Bongo Weekly hasn't changed yet, likely will change soon. Earnings per share far outlying multiple, so Alaska Air looks great. Southwest broke out on earnings, now setting up a high base, looks to want to go higher. Again, good earnings. Delta, a little bit less risky buy, pull back to the 50. Has some work to do. My guess is will go up before the other guys do, or will go up higher. Look at the long-term earnings per share growth. United Continental, sort of sideways. And then JetBlue is another one going sideways after a big run-up. I don't like the weekly bongos being red, which is why I laid off of these for my recommendation. This one looks as good as all of them. This is VLRS, I think a Mexican and Latin American airline, lower left, upper right. Breaking out to new highs. Everything is green, had a kahuna, makes money, higher than its multiple. And then Hawaiian Airlines, pull back in a high base, sort of a flag, breaking out of a squeeze, also looks good. Airlines look great. I mean, when so many stocks in one group look good, you got to pay attention. Biotech, all right, I'll look at the first five. I don't know if I really want to talk about these. If you want to see market manipulation at its finest, here is a stock that its clinical trials failed, and the stock was down at about 30 cents. They announced that they were shutting their operations, and I guess somebody thinks the assets have some value. And the stock went out on Tuesday or Wednesday night at about $2 a share. I'm sitting at dinner with another biotech company, and I noticed that overnight the stock traded up from 2 to 21 because Mark Scarelli, the guy that got everybody in trouble with his price increase on the toxoplasmosis drug, but made a name for himself, started investing in the stock. Scarelli also owns a private biotech, and there was all kinds of speculation that he was going to roll it into this shell instead of a public offering. Imagine if you were short, like many people were, this stock at $2 and you woke up at $20 the next morning with a major margin call. Stock traded back down towards 10, opened way off the overnight highs, traded down the whole day, closing around 10. As the day wore on, they announced that they found new funds to keep the company open. The Scarelli guy owns 50% of the company with his colleagues, and now the stock took off. This is, to me, market manipulation 101. Don't know what to make of it except to say I hope nobody was short that I know. I wasn't short, thank God. Be very careful shorting cheap stocks. You can only make $2 a share, and there's no such thing as a guarantee. I'm not touching this. Let it normalize, get a base, and let's look at it. Sarepta, I was in this one. Sometimes you just get lucky. I had taken a pretty big position in Sarepta on this Bible gap up here. And I made the decision, I did it, actually I think I got it in here. I don't remember where I bought it. I bought it on news. I bought it back then because they had some great news on a muscular dystrophy drug. If you can get a muscular dystrophy drug approved, then you've got major pricing power in a decent sized market. The stock went sideways and really I made some money on it. And then I wake up one day to see BioMarin, BMRN's drug, was going to a advisory committee for the FDA. On that news, people thought that the BioMarin drug was in better place and the market got hammered. So I was sitting on some $35 puts that I was short, some 30 puts that I was long, and I had bought some $25 calls. So the stock is sitting down here, and I'd sold an in-the-money put spread thinking the stock's going to go up and I'm going to make money on my puts. So my puts expired on Friday. So Friday morning, stock popped up. I ended up making money on my put spread when I had a major loss. And why did it pop up? Here's Sarepta. Because BioMarin, when you go to an advisory committee, the FDA puts out their thoughts beforehand, and their thoughts were not very pretty. And look at the dump on BioMarin. So this BioMarin moved up into the 50 and sold off. I'm not in BioMarin, really don't want to talk about BioMarin. What I want to talk about is sometimes you get saved by good news, and I got saved by good news, which took me out of a losing position, actually made it quite profitable on those calls. Sarepta can double from here. Go look at the head of Barron's magazine. Whoever gets approved of muscular dystrophy will make money. Bible gap up on Friday. Again, sometimes it just pays to be lucky. Here's one to think about. And, you know, I'm a technical guy, but I'm going to talk about a fundamental story. And just for full disclosure, I went very long on this stock at the open on Friday morning. I went with probably a 300% position compared to my normal position size. Why? The reason I did this is that probably one of the most dreaded cancers to get, or for to think about is brain tumors. The worst brain tumor is called a glioblastoma multiforme. It's the one that you have less than a 6-month survival. And look at the news that came out on Celldex on Friday. Long-term survival in glioblastoma. Now, this was a randomized trial. There's unmet need and might be enough to get it through the FDA. What do you think this company is worth if it gets an approval in glioblastoma multiforme? It's got a market cap of $1.59 million. Let's look at, well, Clovis would be a bad example. Sarepta's got a market cap of $1.5 million. BioMarin has a market cap of $15 billion. That's $1.5 billion on the last two, not $1.5 million. Let's look at Medivation. $6.5 billion with a drug that they only keep half of the gains from. Let's look at Clovis, where their drug just blew up. $1 billion. So if the stock was at 100, now it's at 30, it had a market cap of about $4 billion without an approval. So I look at Celldex and I'm rolling the dice. If this drug gets approved, the stock is a $30 or higher stock. If there's further positive notice, it's a $30 or higher stock. Buy it on your own volition. It's not my chart of the week. OBV is turned up. It had a kahuna. It's below the 200. It's not at the top of the high jump bar. Everything there is green. I like the story. Biogenidec, not sure what's going to take it higher. It's got some expensive drugs. And Amgen, a lot of takeover talk. I think biotech was really driven by Calabia, Sarepta, and Celldex this week. And lastly, communications equipment. And what's not to like about Apple. Apple pullback here. You know, it's had a doji. There's a lot not to like. I was joking. It's below the 200-day moving average. It's been going sideways at best. Let's give it a little bit more room. No, it's not that much room. Okay. All right. Major resistance, I would think, at this 200-day moving average. But moving up off the 50, I expect it to challenge the 122 range. Everything is green. You know, if this market continues going higher, does Apple break out above that 200-day moving average and go higher? You know, wouldn't totally shock me, but I think that 200-day moving average is going to be resistance 50 weekly, the same thing. So I'm watching Apple. I do have a spread on an Apple where I bought down here, and I've got sold calls at about the 200 because I think that's an interesting target. The one thing about Apple to be aware of, and why my calls will be expiring before earnings. Earnings on Apple are due. They just had them October 27th, so probably the third or fourth week in January. And Apple is in a seasonally okay period of time. Let's look at this. Eight out of 10 years, 8% return starting on November 16th. So I'm long Apple for the seasonality. I set my target above the 200, sold some premium there, and I'll watch how it does and determine what to do with that premium. Cisco, look for, there's CommScope. There was something I liked here, so let's see if I can find it. Juniper Networks, in an uptrend, pulled back to the 50 and bounced. Had a PSA reversal on Friday and a mobile breakout. The bongos are still negative. I do like the earnings per share coming in. Inferna, tight pullback to support. Multiple mobile breakouts, pocket pivots. Still in a weekly bongo red, which is a downside. not necessarily a no buy. And here's the one I like the most. Sienna, pull back to support. PSA reversal, mobile breakout, a squeeze, pocket pivot, Kuhn on Friday. Everything turned green. Great earnings per share coming into the stock. I like Sienna. It's not extended, and it looks like something to be perhaps nibbling at if I want to be in this space. So very quickly, here was my buy watch list. Let's look at a couple of them. A lot of them we've looked at already. Anything that really popped out that I wanted to show you. Cal-Maine Foods. Pull back to the 50. Pocket pivot, mobile breakout. It's still got a weekly bond go red. Look at the earnings per share growth. Look at the PE. Pays a 6.9% dividend. Just curious what the seasonality looks like. Pilgrim Pride is in the chicken. These are in the eggs. We're in a 10 out of 10 positive 11% return on this player here. So I'm looking at a stock in a uptrend channel, in the center of the channel, 10 out of 10 positive seasonality, 11.7% return, pays a dividend of 6.9%. That's why I like Cal-Maine Foods. Go look at Cyrus One in a second, but just if you want to take a look at some of the stocks that I found most attractive. Max Linear, I had looked at a few times, had a big Bible gap up here, sort of a flag. I think it wants to go higher. Great earnings per share growth in the technology space. And then let's look at my stock pick of the week. So my pick of the week is an oldie that I used before, which is Cyrus One, taking with the strength of the REITs and technology. This is a REIT that does its work with data center co-location. So it's a technology-tied REIT. Everything is green, coming out of a squeeze and a mobile breakout, off the 50-day moving average, a PSAR reversal on Friday, a pocket pivot, a kahuna, and OBV wanting to go positive. That's what it got my attention on. I looked on the weekly. I see a beautiful uptrend and a pullback on the weekly, and now wants to go higher. So I like Cyrus One. Let's take a look at it in 1 second. All right, so let's look at it here. So here's Cyrus One. You could see on a monthly, it's clearly in an uptrend. Has a sort of a doji-like formation on the monthly, indecision. You could see on the weekly, it's in an uptrend, but in a pullback. You can see OBV is well above its moving average and pointing up. On the daily, we can see it's pulled back here. This is called the last conditional change. Here's the 200. It's right above the 50-day moving average. You could see here that it's in a daily, weekly, and a monthly bongos are green. This tells me it had a mobile breakout, a PSA reversal, and a kahuna force green on Friday. It's got a PPS buy on the daily. It's in a PPS buy on the weekly. So in a weekly PPS buy, but it's been in a pullback which reversed on Friday. OBV about to go positive on the daily. It's very positive on the weekly. So I did my analysis. Here's what I came up with. Before I go there, let's review the most important slide. Charts of the week. I present a stock for educational purposes only. Trading, especially options, carry substantial risk of loss. I do not warrant any expectation of return, and I may or may not already have a position in stocks presented. I plan on taking the trades if they execute so I can discuss on the following session. And I'm doing this not to provide stock tips, but to openly discuss how I take the trade, why I chose a specific stock or option strategy, and where I plan on taking profits or placing stops. So I took a look at it. I saw that it closed at 35.19. The high was 35.40. I see that the volume is enough, 652,000. I see that everything turned green up above. Mobo breakup from a squeeze, pulling back, broke above the 50, and PSAR reversal. A pocket pivot and a kahuna, OBV turning up. I love the earnings per share coming in going forward, and I don't have earnings to February 17th, and it pays a 3.6% dividend. So I put my buy, target, and sell. Why? So buy at 35.50, which is right above the last conditional bearish change. Target on a 1-to-1 is 37.20, which is right below its pivot. Resistance, my stop at 33.80, which is at the last conditional change over here. So if I can risk $2,000 per trade, I'm risking $1.70, about 5%. I can buy 1,200 shares. So now the question is, how am I going to take that trade? So based upon the fact that I have cash and it pays a 3.9% dividend, I typically check the dividend dates. And if they're any time in the next 90 days, which I'm sure they are, I'm probably going to do stock. Now I'm going to put you on hold for a second and boot up one of my options trading programs. All right, we're going to try this. I'm back, and I'm looking at cone and various trades that I might want to take. I might want to just do a long stock. This last price was 35.19. I can see I have an issue here that since the market's closed right now, I'm not going to get all the quotes that I need. But the last price was 35.19. If I buy the stock, when the stock goes up in value, I make money in green. And when it goes down in value, I lose money. My maximum risk is my investment. If I buy 100 shares at 35.19, I could lose $3,500. If it goes to zero, and my maximum gain is infinity because I don't know where it's going to stop. Now, one of the trades that I like to do is a synthetic long stock. Now, look at that pattern. Now, look at that pattern. Do you notice anything about those two patterns? I notice them. They look almost identical. And if I was to, and let's make this January. It's not going to give it to me because it doesn't have any quotes. All right, let's go back to February, to December rather. So if I was to do a December spread, I would buy a call at 35. I would sell a put at 35. I would collect 20 cents per contract in my pocket, so I get paid to take the trade. And notice it has the exact same earnings and risk and gain as buying the stock. So here I have to pay zero. I get a credit of $20. I still have the same maximum risk and infinite gain. Now, I'm not happy with that because I would prefer not to have a risk my entire position. But again, a synthetic long stock looks the same as long stock. What if I do a call? If I do a call, and let's say I buy an at-the-money call, I'm going to pay $1. So I'm buying the right, but not the obligation, to buy cone if the price trades above my strike price of $35. So my break even is what I paid for that call plus whatever my transaction costs were. So my break even, the stock would have to go to 36 for me to break even. So my potential gain is infinite. All I could lose is the price I paid for the call, which is $1.02 a contract. Likelihood of being in the money is 53% on this trade. So 53% likelihood that I'm going to be in the green. Now, what if I decided I don't want to buy a call, I want to sell a put because I think the stock is going higher? I could be bullish and I could short a put. Similar pattern here, except when I short the put, it's like shorting the stock, but I'm on the other side of the trade. My maximum risk is the price the stock goes to zero, but I put a bigger credit in my pocket. I'm not a happy fan there. What if I do a call spread, a bull call spread? In the bull call spread, I'm buying that 35 call for $1 and I'm selling a $40 call for 50 cents. So I only can make, I'm only paying 52 cents. So even if my trade goes to zero, my maximum risk here is what I paid for the calls, which is 52 cents times 1,000 or times 100 rather, or $52. However, I've now capped my gain, so my maximum profits are $4.47. For those that have modest size accounts that are looking to capture a nice return, a bull call spread here allows me to invest $52.50 with an upside of $447.50, and my break even requires the stock to go up 33 cents. So my break even opportunity on this trade, I think, is very high. So this is a way to take a trade with minimal out of pocket and minimal risk. You've limited your upside, but compare that with the out of pocket. All right, this is a debit of $52. The out of pocket with doing the stock, 100 shares, you'd have to come up with $3,500, or just doing the long call by itself, you've got to come up with $102. Notice on the long call, this continues to go up, you're not capped. So I have this nice little program here, so I'm going to look at the types that I'm willing to trade. Long call, long stock, short call, bull put, and a synthetic. And unfortunately, all this is not populating because I don't have quotes after hours. But then I could look at how much I have to pay, or in green, I get paid, versus I pay out in red. Then this is the gains. Obviously, I like infinity. So this is the one that's interesting here. This is just like buying the stock. I have to pay $102.50 for 100 shares, and I get the exact same behavior as if I bought the stock, with the maximum risk would be it goes to zero, infinite gain. Here's a long call where my maximum risk is limited to the price of that call, and I get infinite gain. So again, just like this, I get the benefits of all the appreciation. If the stock drops, all I'm at risk for is the $162 per 100 shares for the price of that call. So I will look at my various options here, and my trade on this would either be a long call or a bull call spread, where I'm limiting my gains, but I'm also reducing my out-of-pocket. Now, this is a March bull call spread, so I may want to only look at January expirations, and that long call spread, it's not going to give it to me yet. Bull call spread, it's still looking for quotes. Take a look at December, because I know the quotes are there. So looking at the December on the trades that I like the infinite amount of profits, but I want to have the least amount of risk. And there, the winner is a long call that costs me $102 per 100 shares. All I can lose is that $102, infinite gains. And so I would consider either a long call as my trade, or I would buy the stock, or if you have willing to take more risk, since we're in a bullish part of the year, I might look at a synthetic long, which looks just like the long stock, but I actually get paid for taking the trade. and I would buy and sell at the same strike. Now, just keep in mind that your risk is just like you bought the stock. So if I did a synthetic long, notice my risk is 34.80. If I bought the stock, my risk is 35.19. If I did a synthetic long, I would be very careful about where I put my stops because I have huge risk. And just to get you all totally confused, if I look at my synthetic long and I turn it into what I called my chicken shit trade, where I might buy a put at, say, $30, because now I've limited my downside, I've capped my downside. And now all of a sudden, this trade to me is much more attractive. So on this trade, all I can lose is $530 per 100 shares because I put $5 risk here. I'm buying in at $30 for 30 cents per contract, or on 100 shares for $30. I have all the upside and I've limited my downside. So for those that are nervous about doing a covered call, this is a trade that I like to take that basically says I'm financing my stock purchase with, or my call purchase with this put spread. This is a double long position because I'm hoping that the stock goes up and the put spread expires worthless. I've capped my risk because of the second put that I'm buying to protect the put that I'm selling, and I have not affected my profits. Now, the good news is I like this trade. It eliminates some of my downside risk. The bad news is when the stock goes against you, if the stock drops below $30, I have maximum loss. And in this case, maximum loss is $530 per 100 shares. That's the trade that I was in on Sarepta. And thank God the stock popped this week and it got me out of the trade. All right, this stock, for if you're, is actually, it's called Options Pro. You can buy it through VectorVest. The guy's Tom Joseph, the guy that started Advanced Get. Dynamic Trend is their website. You don't have to go through VectorVest to get it. The price is the same either way. But I like to play around with different option strikes and look at different trades before I make my trade. On that note, I've been talking forever. You guys have got to be tired of me. Good night. Have a great week. Have a happy and safe holiday. If you're driving, please be careful.